You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 2nd of October 2023, and I'm joined today by my co-host John McEwen. In this week's episode, we'll be discussing ASOS, Ocado, AG Barr, Hargreaves Lansdown, PZ Cussons, and our US company of the week is Wix. John, do you want to start us off with ASOS?
Yes, so it's the fast fashion retailer, and they had a trading statement out last week with ASOS seeing full-year revenue fall 11% on a like-for-like basis, ignoring exchange rate impacts. And active customer numbers were down 9% to 23.3 million. Underlying gross margin improved by about 1.5 percentage points as lower shipping costs offset the negative impact of the discounted sales. Profit per order improved and return rates were lower than the group had expected. Inventory levels fell by around 30% year on year, and cash and undrawn credit facilities year end were around £430 million. Full year operating profit is expected to be lower, or at the lower end of the group's £40 to £60 million guidance. Second half underlying free cash flow is anticipated to be around £60 million, down from £150 million due to the timing impacts, which are likely to reverse in September and October. The shares were broadly flat following the results. In terms of valuation, ASOS has a market cap of around £450 million and trades at a forward price to sales ratio of 0.1, which compared with a 10-year average of 1.5. And it currently doesn't pay a dividend. I thought these results were disappointing, although we have come to expect in the last couple of years this sort of thing from ASOS, and it certainly isn't as bad as we've essentially got used to. Some of it may be outside ASOS's control. So I know with the wet July and August, that did drive a wider slowdown in the UK clothing markets. That's something that they couldn't do a huge amount about. And it depends how you see it. They did shore up the balance sheet back in May, although that was diluting existing shareholders. And they refinanced, I think, about £275 million worth of debt. They're bringing down the inventory levels as well, which is a positive thing. And they're trying to filter out some of those unprofitable brands, and they're taking a step back in terms of the international expansion, which I wouldn't be thrilled by if I was a shareholder. I think I'm going to have to wait a bit longer before seeing whether this strategy plays out. I don't have shares in ASOS. I do have shares in Boohoo. I wouldn't be looking at ASOS as a company and thinking I'd want to rush in. I certainly wouldn't bet against it, but I think it's going to be a bumpy couple of years. And it's very difficult to say which way it's going. Sam, what are your thoughts on this trading statement from ASOS?
Not fantastic. It is quite concerning, especially as a Boohoo shareholder, because we are getting to a point now where a year ago we were talking about this slide in results, and really we're putting it down to, these businesses got this massive boost in lockdown. A lot of demand's pulled forward. People are now returning stuff that they'd bought in lockdown, and there were all these, there are these reasons why, as we were coming out of lockdowns, you could see why they might have a little wobble. It's looking less and less like a wobble and more like a trend, but it probably is still too soon to tell. But it is getting quite concerning now. I'm beginning to wonder if that 70% loss on Boohoo is actually going to be a permanent one, but we will see. But yeah, it's not great results. It might turn it around, and like you said, I wouldn't bet against it. But that being said, I wouldn't be buying shares right now. The same would apply for Boohoo, even though I was happy buying them 70% ago. But I just wouldn't try and catch a falling knife, because it can always get cheaper. And if the results carry on getting worse, it will. Now, if it does turn things around and get back to where it was a couple of years ago, then it's very, very cheap. But the fact they are halting the international expansion suggests that management don't think they're about to turn a corner.
Yeah.
But
I think, yeah, very worrying about that.
Yeah, but I'm very surprised by how quickly this situation has happened, because it used to be one of them businesses, which is why valuation is just so important. For example, when we look at something like Fever Tree, which I know has not had a great year or so, but it's definitely not as bad as this. But when we were covering Fever Tree, it was one of those businesses that just seemed to keep getting the results, and ASOS was like that. And then it has a couple of years where it's not getting the results, and that valuation's had a long way to fall.
Yeah, no, that's right. And I mean, when we picked up the Boohoo shares, it was high teens in terms of the earnings, which was historically cheap. Although, when the trend continues, it is no longer cheap. It's like you say, it's a value trap, really.
Yeah, we'll see what Boohoo brings tomorrow, but I can't imagine it's going to be radically different to what ASOS have just come out with, but I'm sure we'll cover it next week.
Yeah, so. Praying it's slightly better, but yeah, it's probably wishful thinking on my part.
Yeah, so should we move on to, well, another business that's had quite the fall from grace in the last couple of years as well?
Yes, Ocado.
Ocado, a company that probably doesn't really need any introduction given the amount of times we've covered it, has come out with a trading statement, and this trading statement only really concerns the retail side of the business. So Ocado Retail, which is the 50-50 joint venture with M&S, and that's what you'll see when you see the Ocado vans driving around everywhere. Their revenue was up 7.2% for the quarter to 569.6 million, as prices rose 8.4%. Volumes returned to positive territory in the final month of the quarter, but were down overall. Average orders per week rose 1.9% to 381,000, and active customers grew 1.5% to 316,000. The average order value rose 4.2% to just under £121. Hannah Gibson, Ocado Retail CEO, highlighted that hundreds of new M&S ranges are going live in autumn and that price cuts would go further. There was no change to full-year guidance, including mid-single-digit revenue growth. Ocado shares rose 4.9% following the announcement. Although this does mainly concern the retail, this statement, it is interesting because I would say the future of the business is probably about solutions, and that's why they're charging third-party retailers to use the robotic systems, which is what they're actually using. It's what they've developed to do the retail, and they're using that to process hundreds of thousands of orders a week with the bots that scurry around using the grids. And you can find them on YouTube if you haven't seen them before, but they are very impressive technology. So that looks quite interesting, but unfortunately for M&S, they bought 50% of the retail business, which just seems like a terrible deal. It gets worse and worse the more time that passes, I think. But in terms of the valuation, the business doesn't have any earnings, but trades at a forward price sales ratio of 2.2, and that compares to a 10-year average of 2.9, and there's no dividend yield. I thought this trading statement, so the last time we've covered it, and possibly the last couple of times, as you would expect, they had a pretty good COVID. And then a lot of the customers that they gained started dropping off as things reopened up, and also as the cost of living crisis hit. It looks like they have now reversed that trend. But I think in terms of Ocado, I think they're probably pretty close to saturation in the UK. I don't think their offerings really any more efficient or better than what Tesco or Sainsbury's are able to do with their online and their delivery. So I just think they're pretty close to saturation. So I think this is probably as good as it's going to get, apart from slight increases for the retail. In terms of the solutions business, it's very impressive, but it's also very hard to value. I don't really know what the future looks like, and it's extremely capital intensive. So just because the technology is great doesn't mean the business is going to succeed. And when it's paired with this, what I would consider as quite a poor retail part of the business, I just don't think there's really a price at which I'd be interested in it. Now, if you are someone that has been following it for a while, it is down 79% in the last 3 years, and its market cap has dropped from about 25 billion to 4.86 billion. But I still think it looks very expensive at 4.86 billion, especially considering it doesn't make any profits. So yeah, interesting statement, but I don't think it really changes anything for me. What about you, John?
Yeah, I would agree with you there. I think it's interesting that in terms of the retail side of the business, Tesco's is the biggest of the supermarkets when it comes to home delivery, but it's a bit of a loss leader for them, and they barely make any profit on it at all. And I think if a business that's run as well and as efficiently as Tesco's can't make any money in the delivery side of it, then having that large exposure with Ocado retail, not something that you want. Like you say, it does all hinge on the solutions and I suppose customer fulfillment centers. Interesting with the technology. And you do wonder, and I'm not an expert by any stretch in that sector, but whether it would be a takeover target. I think there's, the shares have rallied on that in the past. Is Amazon or is any other sort of big company interested? But it wouldn't be me. So yeah, I'd just leave it there, to be honest. Interesting business and interesting to follow, but not investable.
Okay. Should we move on to a business that seems to get more interesting the more that you look at it?
Yeah, that's right. I was saying to you off air, AG Barr, the soft drinks maker and owner of Iron Brew, they had their half-year results out. But it's a business, I think, when we first started covering it, we'd always say it wasn't as good as Britvic. And we probably didn't really like it overall. It had some difficulties after it lost Rockstar. But I think the more that we do cover it, the more I actually like it. So with the half-year results, then they had first half revenue of £210.4 million, which was up 10.4% on a like-for-like basis. It was driven by a combination of higher prices and volumes, including the contribution from the Boost drinks business, which was acquired in December last year. Revenue rose by 33.2%. Operating profit rose 6.7% to £27.2 million, and underlying operating margin fell by 3.7 percentage points, reflecting the effect of cost inflation and the near-term impact of the lower margin Boost business. The net cash position fell from £61.1 million to £47.3 million as a result of the Boost and MoMA acquisitions at the end of last year. Free cash flow improved from £4.4 million to £8.6 million. And the group expects to deliver full-year profit performance slightly ahead of market expectations, with analysts currently forecasting an operating profit of £46.1 million. An interim dividend of 2.65 pence per share was announced, which represents a 6% rise. The shares were up about 2% after the news. In terms of valuation, AG Barr has a market cap of £555 million and trades at 14.5 times forward earnings, compared with a 10-year average of 19.4, and it has a dividend yield of 3.2%. I think it's a business with a lot of quality brands in it, perhaps not as strong as a company like Unilever or maybe even Britvic, but they are still nonetheless strong brands. Like-for-like sales were growing at double digits, despite it being a difficult macroeconomic environment, which I think is really impressive. And they're also managing volume growth at the same time and really making the most of some of those brands that they do have. And one of the examples of that would be Rubicon with the new energy drinks that they've launched, and then the Power Brew energy drinks, again from the Iron Brew brand. Other ones which are interesting, the Funkin' cocktails, we've covered that a few times, and that's now, and it has been for some time, the UK's #1 cocktail brand. It has cooled a little bit since when we first covered it with COVID, but still, they've got a decent sales from that too. We'll see how it goes with MoMA. That's, I think, probably a strong growth trend, but will yet to be fully seen. And I think the main thing for me at the moment with the group is that they've had the chief executive, Roger White, for the last 20 years. He's now leaving, and you do wonder what direction it's going to go in. I think with the strength of the brands and the ones that they've acquired recently, probably going to, even if they don't have a particularly good chief executive, with those brands, I think it'll do well. But that is a slight concern. And then the other argument is, if you were in the market for a soft drinks maker, obviously you've got Fever-Tree, but the real rival is Britvic, and that does have its Brazil operation, which we've talked about quite a few times. So it's got more emerging markets exposure. Would you go for that over AG Barr? And that's usually the reason that we present as why we wouldn't choose AG Barr. But I don't think it's a bad business at all. And I like it more and more every time we cover it. Probably not quite there for the watch list, but I still think it's a good business, and these were a decent set of results. Sam, what are your thoughts?
Pretty similar. I do think when you go through the brands, AG Barr is just not as strong as Britvic, but it is a good business, I think. And I think that's maybe something we discounted a bit too much at the beginning. But yeah, it is quite a good business. It seems to be putting up the numbers fairly consistently. And as well, since we started covering it, it's got cheaper too. So despite the fact that it's put up some pretty decent numbers, the PE's a decent amount below the 10-year average. But I think, since we've been covering it, it's usually hovered around 17 times earnings. It's now at 14.5. The prospective yields over 3%. I think it is a good little business, but I'd still get Britvic over it. And as well, Britvic's last set of results, I think it might have been a trading statement, but came out at the end of July. Pretty similar figures to the AG Barr ones, 10% growth. So if they're putting up similar figures, I'll just check the Britvic valuation. It's saying 15.22 on Hargreaves Lansdown for the Britvic valuation. So pretty similar valuation, pretty similar growth. You've got the international side of Britvic, which you don't really have with AG Barr, but you've also got better brands in the first place. I know I say it every time, but I still just wouldn't pick it. Maybe if you're going for a basket approach, you could do Britvic, AG Barr, Coca-Cola, HBC, and do something like that. It's a funny one, because I would definitely wouldn't have an issue holding AG Barr because it is a good business, but I just don't see why I'd ever buy it when Britvic's available.
Yeah.
I think if you're a shareholder, you've no reason not to be pretty pleased with those results.
Absolutely. Okay, on to a company that you used to like.
I used to like, and unfortunately still own, Hargreaves Lansdown. So they have come out with their full year results. Net new business inflows were down 13% to 4.8 billion, although that's still a 4.8 billion inflow. Total assets under administration was up 8% to 134 billion. Revenue was up 26% to 735 million. Profit before tax was up 50% to 402.7 million. Diluted earnings per share was up 49% to 68.2p a share. Total dividend per share was up 4.5% to 41.5p a share. And active clients increased by 67,000 to 1.804 million. They've said that they believe that the addressable market, which is made up of cash and private wealth, for them is currently 3.1 trillion. However, they think that market is projected to grow to 3.7 trillion by 2026. They've highlighted that they've got the number one client net promoter score versus classic platform competitors. I think that's slightly misleading. I don't know what the AJ Bell net promoter score is, but we've covered it before, and AJ Bell have a higher retention rate. So I suspect the net promoter score is going to be higher too. And if it's not, I don't know why they're placing any focus on it at all, because client retention is probably more important. But I don't think they're covering that because they're not counting the AJ Bell as a classic platform, maybe. It just seems a bit odd to be boasting about that when your retention rate's lower than your competitors. But that being said, client retention is up slightly from 92.1 to 92.2%. But as mentioned, it's below AJ Bell's about 95%. In terms of the revenue growth across key asset classes, funds were up 1%. Shares were up 10%. HL funds was only up 1%. Cash was up 21%. and active savings was up 72%. They launched limited access cash ISAs in the year, with rates typically at the high end of the market, and they increased the number of banks and products offered to clients to help satisfy client needs for all investments and cash in one place. And they've said that they've achieved significant results with 85 million paid interest in 2023 versus 26 million in 2022. However, that's slightly misleading again, because part of the reason they've paid so much more interest is because the interest rate itself has gone up. And in the active savings segment of the business, they have a 97% client retention rate, so higher than it is elsewhere. And that's for clients with active savings alongside multiple investment products. So that's very good, because what it's obviously doing is the clients that are taking up the active savings offers, as well as getting more money from them, it's also making those clients more sticky. In terms of the valuation, the business trades at a price to earnings ratio of 11.32 and now has a yield of 5.48%. Now, these results, I don't think there's much dispute in they are a cracking set of results. Revenue up 26%, earnings up 49%. The business gets cheaper and cheaper, much to my dismay, and the yield gets higher and higher. It's now nearly 5.5%, and it's a yield that's well covered. So what I have regrettably come to the conclusion of is, I don't think I realized when I bought it, but Hargreaves Lansdown seems to tick every box for a cyclical business, which I suppose is good, because it might give me a chance to get my money back at some point. But it does just look like a cyclical in terms of the results, and the way the results have. Basically, I think the results are going to rise and fall with the interest rate from now on. The net new clients aren't growing that much more. I like a lot of what they're doing in the business. I like the Hargreaves Lansdown funds. I like that they're pushing the cash and it's making the clients more sticky. But I think they are at a point now where they're already number one. You can see it in the client numbers. The gains are smaller in terms of, well, yeah, the reason they've got so much more revenue, it's not the new clients, it's because the interest rate's gone up and they're getting the money on the client cash sat in the accounts that they weren't getting before. I'm very happy with these results as a shareholder, but I do expect them to reverse once the interest rate starts going down again. And I think that will be reflected it is reflected in the share price. John, what are your thoughts on the results and the valuation?
Very good results, and it seems like a pretty fair valuation. As I've said before, my concern is more that it's a market that's very commoditized, and there has been an awful lot of competition that's been coming into the market in the last few years, and Hargreaves, like AJ Bell, have been forced to cut their fees further. And that would be the thing that I'd be most worried about as sort of, I suppose, the business model. It's a reason that, I do actually have a Hargreaves account. I was going to say, the reason I don't have most of my money with Hargreaves is because I think the fees are very high. And I've been with providers where fees have been higher. And certainly when it comes to ISAs, or even if you have sort of a stock portfolio, transferring is quite easy, a lot easier than it used to be. So yeah, I wouldn't invest mainly for that reason. But I do appreciate it's the number one in the UK, and these were very good results.
Right then, should we move on to PZ Cussons?
Yes, so PZ Cussons, we have covered it quite a few times on the show before. It's the owner of brands like Imperial Leather and Original Source, but many, many more. They had their full year results out, with reported revenue growing 10.7% to £656.3 million as a result of like-for-like revenue growth, the contribution of the Child's Farm, which was acquired in March 2022, and favourable foreign exchange movements. Adjusted operating profit margin was broadly flat at 11.2%. There's an 80 basis point improvement in gross profit margin, funded increased investment in capabilities and offset cost inflation. Adjusted operating profit margin also improved, excluding the Child's Farm, and continued profitable revenue growth in Nigeria contributed to the group's 12.6% growth in adjusted profit before tax to £73.3 million. But the impact of the resulting tax charge and the increased non-controlling interest led to an adjusted earnings per share decline of 10.7%. On a statutory basis, the operating margin declined by 200 basis points, and earnings per share declined by 26.8%, reflecting a £16.5 million impairment of the Sanctuary Spa brand, as well as an increased investment related to the transformation. Cash flow remains strong, with free cash flow of £69.9 million compared with £58 million last year. This includes cash of approximately £200 million within the Nigerian entities, which has been built up as a result of the challenges in repatriating cash outside the country. The board have recommended a final dividend of 3.73 pence per share, which is unchanged on the prior year, reflecting the material adverse impact of the devaluation of the Naira, and that's expected to have an impact on near-term reported financial performance. Increase in gross borrowings to £251.2 million, compared with £174 million in full year 22, reflecting the challenges of repatriating the cash from Nigeria, where the cash balance was approximately £200 million. In terms of the current trading, they have said that full year 24 performance to date has been in line with expectations, with modest year-on-year growth in like-for-like revenue and a higher operating profit margin. And they've seen continued good revenue growth in Nigeria and a stable performance in the UK, offsetting further declines in Indonesia. In terms of valuation, the group has a market cap of £679 million and trades its 13 times forward earnings with a yield of 4.5%. I mean, the headline figures, I think, is certainly a mixed bag. Turnover up nearly 11% year on year, whilst unadjusted pre-tax profit was down 4.2% at £62 million, with a 27% decline in earnings per share. The Naira, interestingly, hit new lows this week, and every 10% fall in the value of the Naira results in a £23 million reduction in PZ Cussons turnover and a £3 million reduction in its operating profit. For me, I think the situation in Nigeria, and given that 39% of the revenue does come from Africa, and how much cash you've got over there is a massive, massive concern. I think the first time we covered it with these issues coming through, we thought it was worrying. I think now it's just at a level where it would be uninvestable. And I think when you look at the valuation, I don't at all think it's cheap enough to even I think it's uninvestable. So I just wouldn't go beyond it. But still, 13 times forward earnings, I think, is expensive given the state of the business and the political instability as well. So yeah, wouldn't touch it with a barge pole. Sam?
That being said, how do you feel owning Airtel Africa?
Good question.
Okay.
I think with Airtel, it's consistently delivering huge growth in comparison. And for the valuation, risk versus benefit, I would go with it on Airtel. Whereas I think with PZ Cussons, you can pay a bit more and get better brands and better growth. And that comes in the form of for example, Unilever. So I wouldn't have a reason to go for PZ Cussons.
I think these results, on the surface, they're not terrible, but at the same time, they're also not great. The cash in Nigeria isn't fantastic. It's not really their fault, but it's not a good situation as an investor. 10% revenue growth on the surface looks all right, but then, you know, we've covered Unilever, we've covered Reckitt, we've covered Nestle multiple times this year. They're all putting up numbers of at least that, really, or certainly around that level. So it's nothing special. And then in terms of the operations, they're all much better businesses. I think some of the brands are pretty good. I think Original Source is a really, really good brand. I think the Imperial Leather brand's pretty good as well. But the others do have better brands. And I don't think it's that much cheaper given the issues it's having. And the fact that, you go back and you look over the last 5-10 years results, it's just not delivered. So yeah, I just wouldn't ever really be interested, I don't think, because there's always other businesses in the industry that I would look at first, such as Unilever, Reckitt Benckiser, Nestle. So yeah, I do sympathise with them a bit because there's not a huge amount they can actually do about the Nigerian situation, but it is not great as an investor. So
Yeah,
I just wouldn't touch it.
and I think on that point as well, if you're sort of comparing it with Airtel Africa, the reason that you would be buying a company like PZ Cussons is because of its defensive nature. And if it's not able to sort of offer you that certainty as you'd expect from those businesses, I think that would be a concern.
But you can do very well buying companies operating in countries with poor currencies. So like Mercado Libre, that's a business I've held for years. Some of the currencies in the countries they operate in have performed atrociously over the last 5 years. But the business has done absolutely fine in that period because the revenue growth has been so much higher than the currency depreciation. With PZ Cussons, you're just not getting that.
Yeah.
Whereas with Airtel Africa, you might.
Exactly. Yeah, exactly. So I think they are, in that sense, sort of different kettle of fish in terms of the types of business.
Yeah.
And the health of them, but interesting anyway.
So our US company of the week, which is actually, so it's listed in the US, but is actually Israeli. Same for Fiverr last week, which I did forget to mention. So Wix, for anyone who's not familiar with them, although we have covered them before, they are a platform where you can basically create websites for free. And then if you like it and you start building a little business on there, you can then add on extra stuff and do extra things. And that's when they start charging you. And what really works is, you start when you're free. You start because it's free. And then all your stuff's on there. It's a hassle to move it. And, it does make you very sticky, providing the business takes off. These are slightly older results. However, there wasn't anything interesting that I wanted to cover this week, and I haven't looked at them yet. So these results are about a month old, but they've come out with their Q2 results for the 3 months ended June 30th, 2023. And revenue was up 13% to 390 million. Of that, creative subscriptions revenue was up 11%, and business solutions revenue was up 18%, with creative subscriptions revenue making up about almost 3/4 of total revenue. Gross profit was up 24.6%, and they've now got a 67% gross profit margin. Total operating expenses were down 13% to 249 million, and net income has swung from a $111 million loss to a $33 million profit, and that gives them an 8.6% net profit margin. And their diluted net income per share for the quarter was 56 cents. A few things in the slides as well. So they now have total registered users of over 254 million. Their creative subscriptions annualized recurring revenue is 1.2 billion. Their transaction revenue for the quarter was 45 million, and the partner revenue was 115 million. And 40% of their revenue is from outside North America. The annualized recurring revenue from the creative subscriptions is increasing. So that was up 10% year over year to 1.16 billion. They've talked about their partner revenue as well. And partner revenue is defined as revenue generated through agencies and freelancers that build sites or applications for other users, as well as revenue generated through business-to-business platforms. And partner revenue is up 36% year over year and 125% over the past 2 years. Transaction revenue, they've also talked about, which is a portion of business solutions, and it's defined as all revenue generated through transaction facilitation, which are primarily from Wix payments, as well as Wix POS, which I think is point of sales, shipping solutions and multi-channel commerce and gift card solutions. Transaction revenue is up 21% year over year and 165% over the last 2 years. Similar to what we had with Fiverr last week, they group their customers by the quarter in which they acquired the customer. So they put them in cohorts. So for the Q1 23 cohort, after just 2 quarters, they've already got 1.3x of the marketing spend that it took to get them. For the Q122 cohort, they've got 1.4x after 6 quarters. That's quite interesting, actually. The ones they got 2 quarters ago are basically more valuable already than the ones they got a year ago. The 2021 cohort, after 10 quarters, they've got 2.1x of the spend to get them. Q1 2020 cohort, they've got 3.5x, and Q1 2019, they've got 4.1x. So the lifetime value of a customer is very high compared to how much it's costing to acquire them. And they've said that they expect future bookings over the next 10 years from the existing cohorts alone to reach 15.6 billion. And the current market cap is only 5.16 billion. So they expect to take in over 3 times their market cap in the next 10 years just from the existing customers, assuming they don't acquire anyone else. In terms of the geographic split, 63% of revenues from North America, and the North American segment is up 21% year over year. Latin America makes up 4%, and that's up 9% year over year. Europe makes up 23%, and that's up 2% year over year. And Asia makes up 11%, and that is up 3% year over year. And they are expecting to generate free cash flow margin, excluding investments in their headquarters and one-time restructuring costs, of about 15%. So in terms of the valuation, the business trades at a market cap of 5.16 billion. It's quite hard to value at the minute because it's just started. The price sales, I don't think that's particularly helpful in this case, but it's just starting to turn a profit. It's bringing in a lot of cash. The customers are very valuable. I think probably the only thing that's maybe worthwhile is the price to gross profit. This is trading about 5.5 times gross profit. You are starting to get a bit of operating profit trickling through, but it's going to take a few quarters for the previous losses to wash out. And then free cash flow margin of 13%. So you're starting to see some profits for it. So it's very hard to value, but I think probably the main thing for me is probably the amount of money they're actually taking in compared to the market cap at the minute. It is small. This was a stock that did very well in COVID, as you would imagine. It is down from a high of about $348 a share. It's now at $90 per share. I am a shareholder of this business. I think I'm down about 20 or 30%. So I've done a little bit better with this one in terms of actually trying to call a bottom. But yeah, I'm pretty happy with these results. Well, I'm very happy with these results, very happy with the performance. I think it's a very good business. And I think they've got a few areas of the business that look interesting as well. So despite the growth starting to slow in some areas, you've got the transactions and the partners payments. So yeah, I'm quite very happy with this as a shareholder. John, what are your thoughts on the results in the business?
I like the business. I thought the results were very good. It seems to me like it's a very high quality business, lots of recurring revenue, and they're able to grow more or grow the revenue further from those existing customers. It would be a business that I'd be interested in owning. I always find these tech companies quite difficult in terms of their valuations. And certainly, I remember when you were sort of buying shares, and it was around that sort of 2020, 2021 time, I think, and it did become eye-wateringly expensive. I think probably fairer value now. So I might take a more serious look at that. Fiverr, Upwork, Etsy, a few of those companies, possibly taking sort of a basket approach with them, but they do look like great businesses and at certainly more reasonable valuations than they were just a couple of years ago.
Going back to that valuation, so I think probably the best way actually to do it is if you take the revenue, so if you do the market cap and then you do, so they're saying they're expecting 13% free cash flow margin with those a couple of exclusions, which I think are fairly reasonable. If you assume a 13% free cash flow margin on the current revenue, that would give you a price to free cash flow of 27 at the minute. This isn't like something this is talking what they're talking about doing this year. So it's that will come down very quickly. And then as well, it's still growing well. It's not like they're just cutting. It's not like for example, with ASOS, where the revenue is dropping and they're cutting costs to try and compensate. The revenue is still growing, and it's growing pretty nicely. In some areas, it's growing very well. But yeah, so it's pretty reasonable, I think. I'm pretty happy. I wouldn't be against adding to it. I think I've only added, I think I might have added to it once.
Resisting that temptation.
I don't mind with this one because it's not I don't mind being down on businesses like this because it was one where I was watching it. I think I had a nibble at it when it was quite expensive, and then it dropped a lot, and then I bought most of what I own then. So my average price is, I'm only down about 20%. But when you've got businesses that were dropping 75, 80%, you're just not going to catch the bottom.
Yeah.
So I bought it knowing I could well end up down 50% or something like that. So, it seems to have leveled out a bit. So it's $90 a share. I think it went it went all the way down to $60 a share at one point. So I was down about half, but now it's about 20%. So yeah, pretty happy with this one. It seems to have leveled out a bit, but we'll see. So
good.
Of the 6 businesses this week, then ASOS, Ocado, AG Barr, Hargreaves Lansdown, PZ Cussons and Wix. If you had to buy one, which one would it be?
Ooh, possibly Wix. Close second would be AG Barr. And last, maybe Ocado. But PZ Cussons and ASOS are also down there. And not keen on those at the moment.
I would also do Wix, probably is my first choice if I exclude it because I already own it. It'd be between AG Barr and HL, but I also own HL, so AG Barr. So then, yeah, the least favorite would probably be Ocado, just because I think with ASOS at least there is a profitable business in there.
Yeah,
and there's a pretty reasonable chance that what's going on is just a bit of a wobble rather than something more permanent. But yeah, with Ocado, I just really don't know of it. It's an interesting business to follow, but I wouldn't be comfortable owning it.
Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.